A sharp spike in volatility on financial markets, but no change in the firm language from the RBA that inflation remains our main problem. Our latest thoughts on the outlook for the domestic economy and global markets. The jump in US unemployment from 4.1 to 4.3% sent markets into a tailspin last week as the assumed US soft landing scenario was put to the test, driving bond yields sharply lower along with stock markets, and also extreme volatility for currencies. Markets appear very prone to overreactions at present, which is understandable given the extent of recent bull markets for equities and the assumption that conditions will remain benign, so a correction at best was somewhat inevitable. How this plays out now is anyone's guess, given the VIX index of volatility has spiked to its highest level this century outside the pandemic and the GFC. But the implications for US interest rates are clear. The Federal Reserve will cut rates in September, although calls for a 50 basis point cut also appear to be an overreaction. Similarly, here there have been sudden swings in opinions around RBA monetary policy, with the market briefly pricing in another rate hike until the quarterly CPI data landed on the low side, with core inflation dipping below 4%. But equally, the subsequent renewed calls for an RBA cut by year-end appear to be another market overreaction. Michelle Bullock sensibly pushed back on the notion that the RBA could cut rates this year, given the necessity to fully contain inflation to deliver sustainable economic growth and real wages growth. So we'll need to see core inflation closer to 3% before the RBA can cut rates, which we still expect to occur by May 2025. In times of high volatility, it's important to consider outlier scenarios that could change these timelines. And while we don't expect another RBA hike, one scenario that could put this view at risk would be another rise in excess demand in the economy and in labour markets, perhaps driven by the recent tax cuts and other fiscal support. So the next few reads on employment will be important for official interest rates and in comparing where the RBA are in the transition to an easing cycle compared to other central banks. As the chart shows, our labour markets have been more resilient than elsewhere, so any fall in our jobless rates from here would add to the risk of another RBA hike, although we don't expect this to occur, and any move prior to November and the next quarterly inflation data is highly unlikely. Conversely, the case for an RBA cut, while still tenuous in our view, would be enhanced by a sudden jump in our unemployment rate or any dislocation in global markets. So, while the recent sell-off in equities is currently being described as a correction and not a bubble, stability in the markets is a key consideration for central banks. Similarly, volatility in FX and bond markets has been elevated, but we'd need to see a major global issue for the RBA to be influenced by the financial markets. As we've stated before, the end of tightening cycles is generally messy and unpredictable, including for central banks themselves, and especially here with such inconsistent and uneven conditions around Australia. But in short, the RBA should be in a position to cut rates next year, around 6 to 9 months after other comparable central banks. The timing here will be dependent on core inflation getting closer to 3%, which we hope to see early next year. And while conditions for households are highly challenging due to the surge in inflation, real disposable income is forecast to improve next year. The silver lining, perhaps, is unlike during the pandemic when rates were near zero, at least the RBA can cut rates from above 4% when conditions allow. And that's the market update from Bendigo Bank.